Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
Be wary of the tax traps on pensions on divorce. In a recent podcast, I explained how the lifetime allowance tax charge applies to pensions. Essentially, it's an income tax charge on the excess amount above the lifetime allowance, which is currently £1,073,100, and occurs whenever a so-called benefit crystallisation event, or a BCE, occurs. The lifetime allowance is not a cap on the amount you may have in a pension. Rather, it is a limit above which a tax charge will occur at some point in the future. The lifetime allowance was introduced in April 2006 on so-called A-Day. You might wish to consider applying for protection if your pensions are expected to exceed the lifetime allowance threshold. So what is a protected lifetime allowance? Basically, there were and are schemes that allow you to protect your lifetime allowance at a higher level than the standard lifetime allowance amount just given to you. First one is primary protection. We then have enhanced protection. We've had fixed protection 2012, 2014 and 2016. And we've also got individual protection 2014 and 2016. Interestingly, only individual protection 2016 and fixed protection 2016 are still available to claim if your pensions were worth more than £1 million based on the lifetime allowance calculation on 5th of April 2016, but with some exceptions. I'd like to focus a little on the most generous of all of these protections, known as primary protection. This was introduced to protect people with total pension benefits of 1.5 million or more on A-Day on 5th of April 2006. Interestingly, once you've made this protected allowance claim, you can still continue to accrue pension benefits after 6th of April 2006. That's not the case with all of these other protections necessarily. The lifetime allowance is calculated based on a calculation known as the Lifetime Allowance Enhancement Factor, or LAEF for short. The benefits in excess of the lifetime allowance charge are still subject to lifetime allowance excess tax charge. Primary protection is extremely valuable because it can be far greater than any of the other protections, which all vary between £1,073,100 and £1.8 million, whereas primary protection could be worth several £1 million. In fact, it could run to far more than that even. So at this juncture, I think it's important to explain to you the three ways of sharing pensions on divorce. Now, the first one of these is called offset. The second one is earmarking orders. And the third one is pension sharing orders. Now, offset is a way in which you, working with your lawyers, would agree the division of assets on divorce, which may include property, pensions, investments, cash savings, etc. And a simple way of doing it is just simply to get the value of the pensions. There may be businesses as well, for example, or properties. Get the values of all of these assets, work out what they're worth, and just divide them between the two of you. It may just be neat and tidy where the pension, for example, may go to one party and the house may go to another if they've got similar values, so you don't have to worry about the complexity of dividing up the pension. It's just a clean break, simple way offsetting the value of the assets on divorce. A more old-fashioned and very rarely seen way of sharing pensions is known as earmarking orders. As I say, they're virtually unheard of these days because they've been overtaken by a far better method of sharing pensions, known as pension sharing orders. What happens with a pension sharing order? Well, if the pension is going to be divided between husband and wife, the normal course is to get it valued independently. And if the decision is to split a certain percentage of the pension, say from husband to wife, then the amount that gets taken out of the husband's pension is known as a debit, and the amount that goes to the pension for the wife is known as a credit. Now, what's important to be aware of is that certain lifetime allowance protections will be lost or reduced on divorce unless you take professional advice. But interestingly, there's only 2 of these enhanced protections which can be lost or reduced, and that's the primary protection and individual protection. So what I thought I would do at this stage, because it's all quite complex, is just give you a couple of examples of a couple of people with large pensions. I'm not going to go into the full calculation because it's hard to get it across in a podcast, but I just want to use the figures to give you an idea of the different results you can get if you do decide to divide pensions rather than other assets on divorce. So for example, let me use an example of someone called David. He has protected pension rights on A Day on 5th of April 2006 of £3 million. The court has decided that he should give £300,000 out of his £3 million pension as a pension sharing order to his wife. So his protected pension rights reduced from 3 million to 2.7 million. There's this calculation, this lifetime allowance enhancement factor calculation, which basically results in a lifetime allowance of 3.24 million, which interestingly is higher than it was before the debit deduction going to his wife. So his lifetime allowance is now higher by £240,000. In my other example B, shall we call it, let's use the name of Simon for this fella. His protected pension rights on A Day, 5th of April 2006, like in the first example, David, were £3 million. The difference is he has to share far more of his pension to his wife, presumably because there's less other assets that can be shared, but isn't necessarily always the case. So his pension is reduced by 1.6 million pension debit, from 3 million down to 1.4 million. Now, the problem here, if you can remember what I've said to you earlier during this podcast, is that means from 3 million to 1.4 million means that his pension for lifetime allowance purposes now falls below the limit for primary protection of 1.5 million. So what has happened now is that his lifetime allowance was 3.6 million before this pension debit to his wife of 1.6 million. It's now reduced to the standard lifetime allowance of 1,073,100. So if you're with me so far, that means he has lost just over £2.5 million of protection in exchange for a 1.6 million pension share in favour of his wife. Now, that's pretty swinging. So in this example B, Simon, who started off with the same amount of benefits for primary protection as David, because he was hit by a much larger pension debit, much larger amount to go to his ex-wife, he's actually lost out substantially with a reduction in lifetime allowance from 3.6 million right the way down to just over 1 million, whereas David has actually benefited. His lifetime allowance has actually increased from 3 million to 3.24 million. Quite an extraordinary result. And when you consider that the income tax charge on the excess above the lifetime allowance on lump sums is at a rate of 55% and 25% excess tax on the pension income, then the additional excess tax charge on Simon is considerable in this example. This is why if you're fortunate enough to have a large pension and unfortunate enough to get divorced, do make sure you get expert pensions advice on divorce from a qualified and experienced pensions on divorce specialist. You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.